Good morning and welcome everyone back to the Schwab YouTube coaching channel for our Monday edition of Trader Talk in today's market. I am your host, Kevin Horner. It's a brisk morning in Denver, Colorado, and today I am pleased to be joined by my friend, Mr. Michael Bruskoff. Michael, it's great to have you back on the show. How was you? How was your holiday week, buddy?
Hey, good morning, Kevin. Happy holidays to you. Great holiday so far. Looking forward to a new year coming up in the middle of the week this week. But lots to talk about going on in the market today. I think that's what we're here for today, Kevin.
You nailed it. You are absolutely right. Back-to-back holiday shortened weeks, of course, with Thursday being the holiday. The market will be open on Friday. But we're going to kind of set the table as we do on a Monday, try to get you all squared away with what you might be wanting to hear about in the market. There are some significant moves underway in a couple of key areas that we're going to look at, most notably precious metals. So put a little pin in that one. We're going to get to that a little later today. We are joined by Ben Watson in the chat this morning. Say hey to Ben. He'll get to comments and questions. Mike and I are unable to, but we want to hear from you. So we'll keep an eye on what's happening there in the chat and try to bring your comments and questions into the discussion. Make sure to follow us on X. I'm available there as Kevin Horner CS. You can follow Ben at Ben Watson CS as well. We do try to offer you some multitude of posts throughout the week. I have been hitting hard the charts this last couple of weeks, everybody, finding opportunities one way or the other, at least some significant movements, and I love posting those. So if you're looking for stocks that you might not be thinking about or stocks you might not have heard of, perhaps patterns that are developing, that's the kind of stuff that I'm throwing out there on Twitter for y'all. So please do feel free to follow us there. Let's get to those disclosures, everybody, and then we're going to jump right on into the discussion. So first of all, we'll remind you that our conversation is exclusively for your information and your education. We do not make recommendations. We do not endorse any specific approach to trading the market. We will, however, discuss technical analysis. But remember, we do not encourage you to base your decisions exclusively from technical analysis. What we try to offer you here in our class is an understanding of concepts and strategies traders might choose to employ. However, they are merely that concept. So please do your due diligence, build them into your own process if you'd like, but do not base decisions exclusively off technicals. And of course, in this class, we follow a market analysis approach. We start broadly, top-down method. We'll work through our biggest indices, work our way into sub-industry groups. As I mentioned, commodities will be one of those sub-industry groups we'll be talking about, certainly hitting on transports and semiconductors as industry groups, and then we work into sectors and, of course, stocks in the news where we have the opportunity. So we'll bring those to the table as well. So with that, Mike, let's take a look at this final week of the year. We've been dabbling in this upper elevated 6,900. We got up to that new high 6,945 on Friday, a day I completely ignored. I don't know about all of you, but it was not a day where I was paying a whole lot of attention to the market. But it looks like we're just kind of breathing at this elevated level 6,900 yet again.
Well, Kevin, number one, it's okay that you didn't look at it on Friday. It's the lowest volume of the year, so it was okay. But the truth is, I say that sarcastically. Listen, we're touching all-time highs. So what? It's not difficult for us. It's not like we're blowing out. We're at 7,500 right now, and we were at 6,900 last week. We're at 6,900. We've been creep crawling along, establishing new highs. I think I saw, I might have read wrong, Kevin, this weekend, 32 new highs on the year. Right? So up 18.5%. Listen, I like the pattern that you're showing there right now where, we're above the 20, we're above the 50, above the 200, but more so we've taken that stair step approach kind of moving up in the market, right? Where we've had some backing and filling. I kind of, where we are right now, I don't say that I have a nosebleed. We're not super far above that. We're a little bit above that 200, so I do like, those elevated levels above the 200. I do think if we were probably to break back in below the 50-day moving average, we might start thinking about things a little differently, which obviously that can happen pretty quickly. But right now, the move up in the market, it's been a strong move over the last couple of weeks with the market. Kevin, I'd love to hear your thoughts on that.
Well, I feel very similarly, Mike. Obviously, on the final week of the year, I'm highlighting the fact I've got my return details up here. I hope everybody can see. Upper left corner reflects year to date, just shy of 17%. On the heels of back-to-back 20 plus, 25% plus SPX years, Mike, not a terrible follow through year. And in fact, a really good follow through year off of our lows. I think a lot of SPX investors, a lot of SPX holders here would be very pleased with what they've gotten out of things. And obviously, the elevated level when you're this close to all-time highs, no one's going to be too concerned about that. Now, I think one thing I'll bring to the table here to follow on this discussion, Mike, is one of our friend Rachel Deshell's charts, and it's that correlation here, looking at SPX and the number of stocks in the S&P 500. First of all, this top section here, this is stocks over the 200-day moving average. So we're looking at a line where we are now at 62 almost percent, Mike, of stocks in the S&P over their 200-day. That is exceptionally good over a long-term window. If we look at the short term, Mike, you can see 64% above their 50-day. That even speaks higher to the intermediate term and helps me to think that perhaps we are witnessing the true broadening out of a market rally in a very broad-based index, certainly led by tech, but broad-based nonetheless, meaning we are getting carry through in groups we haven't seen recently.
Yeah, Kevin, I think that, we've as market followers, people who really take an interest in the market. I think that's what we've been begging for I'll say a long time. Over the last, again, you can see it very clearly on this chart that you're showing, over the last 6 months, the broader participation in the market. Hey, Kevin, let's just talk about the Mag 7 all day long, right? It gets kind of boring all day long. So we've been hoping, hey, the Russell could start to rally. We're starting to see more stocks and this is an S&P 500 chart specifically. It's just not that Mag 7, right? It is other stocks participating. And from our point of view, that's what we've been wanting. Hey, get rid of the leadership. Let's change leadership from those same 7 stocks. Can we get somebody else to start participating with this market rally? So as we stand at the end of 2025, I'm actually kind of happy that I see that, because you can look and see where we were in April, right? And again, obviously we know the news that came out in April, and we're almost a little higher than we were at this time last year, right? It looks like maybe we were a little below 60%, right? So now we're a little above 60%. Now, from the stocks over the 50-day, that's a huge improvement from this time last year, right? So again, the S&P participating, maybe some of the laggards, air parentheses, the laggards of the S&P, maybe they're starting, just getting above the 50. Maybe we can look for a little more optimism as we start saying, February, March, April. Maybe we get more stocks above that 200-day, and the number even goes a little bit higher. That's a potential. I'm not saying it's going to happen, but that's what this is indicating, maybe, that we're at least at a good spot in the market.
Yeah, maybe so. I do also want to call out, Mike, that looking at our NYSE, this also kind of stands out. That's a different number. That's about, 2,600 stocks in the NYSE. This is stocks making new highs. Now, that number is that's not a great number. We're not showing. I think what this might say, Mike, is that some of those groups that are now providing short-term leadership for us may be providing near-term leadership, but they're not at extended 52-week highs. All right, they're at movement. They're doing well coming off of their lows, but they're not making new highs. Is that fair? Is that why maybe we're seeing the NY? That's again a very big group relative to something like the S&P 500 or even the NASDAQ 100. Those are much smaller.
Not the topic on this chart, but we've been getting excited that the Russell's starting to break out, starting to hit new highs. Russell's hitting new highs for the first time in months, in years that it's hitting highs. Whereas I was joking around with the S&P 500, hit 32 plus this year. So maybe when you look at that New York Stock Exchange chart that you just were showing there, it's a little slower cooking, a little slower moving for the broader part of the market. That doesn't make me jump up and down. I'll be honest, it doesn't. But if we can say the 50-day is a leading indicator, and then we can get some more stocks moving in that direction, that would be, I continue to have a slightly positive tone. I'll be honest, that red line, the orange line right there doesn't make me jump up and down. You do want to see broader participation. You do.
Exactly. And that's really all I wanted to say. Obviously, we would prefer to be making a whole bunch of new highs across the NYSE, but it's not necessarily a negative that we aren't, because some of our leadership groups are those that are coming off of lows as opposed to dabbling near highs. And at the request of some of you, I'll go ahead and get you this grid that we just highlighted. Again, our friend Rachel Deschelle built that for me a few months ago, and she and I have been talking about that in our segments together, and I frequently will bring that into this discussion here because it seems so pertinent to our topics. I do want to remind you that our grids are not guaranteed for timing or accuracy, so please keep that in mind, but you are welcome to upload that into your own Thinkorswim desktop platform. Mike, let's move off of the SPX, talk about the NASDAQ 100, pulling back about 0.25%. But ultimately, Mike, a 20% year again here in this big index. And my lines are kind of accurate, but when I just pulled this up a moment ago, I almost feel like I need to adjust this line because this looks much more like consolidation going on over the last few months here. Your thoughts?
Kevin, you read my notes that I wrote to myself, right? That's exactly what I highlighted to myself on the NASDAQ, right? So is this a pause? You're making a triangular pattern right there. What does that mean? If you look at those highs that you have that high where it says 26,182, then you have a lower high a few weeks later, and then we sell off, and then we have a lower high again. So we've had two sell-offs in that chart that you're showing right there, two new lows, but they were higher lows. The first low was a new low. Then we rallied, lower high. Then we sell off, higher low. Now we rally again and we make that lower high. We don't hit a new high. So some people call that triangular pattern could be a pause in the upward market. And the continuation would be as if you drew a line down from that high down to that low. And if we were to break out of that triangle, maybe we would have that little bit of a rally, right? A little bit of a rally to kind of push us through to new all-time highs. That being said, NASDAQ's been led really by seven main stocks. Seven main stocks over the last couple of weeks haven't been as strong as they've been all year. Hence that term lower highs that you're seeing right there now, Kevin.
Yeah. And yet, that first line I had drawn, Mike, was kind of through these peaks in here, right? Because there's been, we've been beaten back from this about 25,800 level. That line is still valid in the midst of this
100%.
triangle, I think, because getting through 25.8 into 26,000 to the upside on a close would look like continuation or breakout of this consolidation. Yeah.
Yes, it would. Yeah, that's how I would interpret it if we were to break out. And like you said, it might not be so easy. Not only do we want to break out above that line, we want to break out above that middle peak. That middle peak is, it will be resistance, as you said. If you kind of turn your line just as a straight resistance line, it's going to become resistance there.
Yeah. And that's because, Mike,
exactly.
Technical analysis 101 stuff, right? If we close above this white line drawn in, we have a higher high. And that's what we're looking for is continuation, higher high, higher lows, etc. We can always fall back into those very standard tenets of technical analysis and trying to understand what's happening in the trend. So, tech stocks doing well, doing not as well, right? It's in recent. We've been consolidating. So really the question becomes, are we going to start 26 with more tech-heavy rallies, or are we going to see that expand and maybe tech lags for a change and we get returns out of some of those bigger groups, which we're going to touch on. And I'm sure many of you who are here frequently already know those sectors we're going to hit on that have been leaders of late. Let's kick off of the NASDAQ. Let's look at those small caps today. They are our relative strength performer today. They are down, but they're down by a lesser percentage than the rest of the big indices. And I've been watching that bull flag, Mike, holding the level outside of the bull flag. Very important short-term test here on the 20-day, I would think.
I think for continued support of the breakout that you had where you hit that all-time high, yes, we pulled back into your 50-day moving average, and then we rallied, and we're kind of hugging the 20-day right now, right? So I do think from a technical perspective, probably would be better off for this to stay above the 20 for the pattern that you're showing right there. Be a little more bullish if we could stay above that 20. Gets to be a little, I don't want to say bearish, that's not the right word, but I've become a little more negative if we start to get back into that channel. And certainly if we were to touch below it, the lower end of it, which would break us down below the 50-day, break us down below the 20. So this is a critical spot, I would say, to hold to hold at least some optimism for the next week or couple of weeks from the market's perspective.
Yeah, I say, and you use the word critical, but from a trend standpoint, the reason it's critical is because of that action outside of that bull flag. We could invalidate that bull flag pretty quickly. If we closed under the 20-day, we could easily be back at this confluence of horizontal support in the 50-day. And that's only 60 points. So, not a huge percentage basis, like 2 to 2.5%. And still, it'd be in trend. You just want to see the continuation of our short-term stuff more than anything, I would think. Year to date, Russell up about 13.5%, a good year for it. Of course, we could certainly, it would be a tremendous year if we saw the Russell leading in 20+% return points like we've seen the others. So good year nonetheless, though. Let's see how those yields are impacting this potentially, Mike. We've been talking about this for a while. You and I have touched on this a couple of times. I mean, I only get you here once a month, really, but I know I've brought this up. That 4.2 level, once more, a level from which we've been pushed back on the yields. Mike, what are you watching here? I mean, I've been talking about that downtrend line being broken and all of our action over the last month above the 50-day moving average. Is this yield starting to look a little more bullish?
Kevin, I think it's when we look at the at that trend line right now for the 10. This is the 2-year, correct, Kevin? Or this is the 10-year?
This is the 10.
My apologies. It's the 10-year. Yeah, I'm losing my thought process here. But I think if we look at that, the economy is really based on we had the shutdown for almost 60+ days, and the government shutdown. A laggard of economic reports have still not come back out yet. So I do think we're looking at some, we had CPI, early about a week and a half ago. We had unemployment hitting 4.6%. I was looking at the Fed Fund futures earlier this morning, out through April, Kevin, still pretty much has us 3.5 to 3.75. So the expectations of the market really moving interest rates in the next 3 to 4 months, obviously weather dependent, you know what I mean? Economic report dependent. I feel that the market's getting in a little bit of a comfortable zone with where we are in interest rates right now. And I think when you look at this 10-year right now, 4.1% right now, it seems like we probably can hold there. And the fact that we broke out of your downward trending line, are we making a new trend? No, we're pretty much just going sideways right now. But I think if we can maybe get a little bit of a break above the red line, that negative, I'll call it resistance line for you, if we could break above it, I think things would, I think we feel the market's telling you right now it feels pretty comfortable with where interest rates are. We haven't really seen a sideways move like this in a couple of months. You're showing a 6-month chart right there, and this is the most that it's been consolidated in a while. And if you pulled up your year chart, you would see the same thing. So I think the market's growing accustomed that interest rates, Kevin, are I didn't want to say the wrong word, at a level that the market can sustain right now. I think that's the best term that I could use.
Yeah, and relative to what you said about the CME, the CME Group expectations on rate changes and what have you, that group is positioned for, at least currently, traders are positioned for an expectation of 50 basis points lower between now and next December's announcement. Now, that's only 2 rate cuts, but you all know that conversation around rate cuts is as important as actual rate cuts. So the more we continue to hear about, the Fed's thinking about cutting rates, what does the market do on conversation around the potential for Fed cutting rates? The market loves to hear that. The market uses that as a catalyst, and typically we see rallies to that extent. The concern as it relates to the 10-year bond, I think, Mike, is simply tied to whether or not the U.S. economy is as healthy as we need it to be. I mean, the concern in my eyes would be whether our sovereign international companies are willing to continue to buy U.S. treasuries. And if they are, well, then that's good. And it is apt to keep yields lower. If they start selling U.S. treasuries, we're going to see yields rallying, and that's going to put pressure on some of our more important areas of the market. In my head, most notably housing, which is a huge chunk of our economy, obviously, and still in a little bit of a stall right now, needing to see that kind of break free. So we'll see how these yields play out. How about some semiconductors? We're off nearly 0.75% here today. Now, we've been in consolidation for a while. Let me change this chart here. But we bounced again, Mike, into that 20-day, and now we're kind of, we're above both or at the 20, but above the 50. It's just been really choppy in the semis for the better part of the last 3 months or so.
Kevin, what you got up there is a lot of backing and filling, right? It seems
Yes.
like, when I say backing, filling, we're grinding. They're grinding up, Kevin, right? You still hit that high. It's just not going to be straight vertically up, which I actually think is a little bit healthier than going parabolic. When we get to the metals in a few minutes, we'll talk about that. But I'd rather see some backing and filling than straight parabolic straight up, right?
Yeah.
So I think that makes me feel like that the market, it's hard to say this term, common sense, right? That the market has some common sense and things just don't go straight up, Kevin. I mean, hey, buy it today. It's just going to keep going up to infinity. I like that the market has some volatility. I like that the market has some backing and filling. And it's been, it's been kind of sensitive to, to A, economic reports, and B, it's been sensitive just from the industry itself. Is AI overbought? Is it not overbought? And the stocks, the chip stocks are the ones that are kind of driving the AI rally, lack of a better term.
Yep. And can we open the door to selling more chips to China, for example, which will open opportunity, right? And that explores more upside in NVIDIA, which obviously is the number one position there in the semiconductor index in terms of size. So yeah, all of that matters. That narrative is unlikely to shift a whole lot, I would think, in 2026, Mike. Semis this year, nearly 42% up. That's an incredible move. And if we looked at it just from the bottom back here in the April move, how about a 117% move to the peak? That is pretty fantastic. So if you're looking for a group, a large group that has volatility, you could say that applies to the semiconductors, Mike. There's no doubt about that. The improving space in our market of late has been the transports, and the transports have managed to continue to hold this upper elevated level. Now, of all of our industry groups, maybe not the best. I mean, 11% year to date. But Mike, it's this move out of consolidation that's been most notable, and it has been led by all three of the big pillars in transports. Jets and planes are up, trucks are up, railroads are up. Are we witnessing something important here, or are we just sitting a little bit of a relief bounce into resistance?
Well, I think it's pretty much a measured move from 16.5 to 15 was about 1,500 points, and you got that 1,500 points on the upside right now. So you're kind of right there. Listen, I think oil has been a key player in the price in the movement of transport.
Absolutely.
Right. I think especially when you talk about the airlines, you take a look at that, take a look at the truckers. The biggest cost, obviously, for all of those companies is the price of oil. And a week and a half ago, we were at 52-week lows. Right. Yeah. So, so I think that's maybe as we talk about changes and, the market's always slow to move. Maybe this might be an area that we might want to look at next year. Right. Maybe the energy sector, maybe the transportation sector. Maybe we have some opportunities in some stocks that have been, I don't want to say out of favor, but they haven't been the main stocks that the market's been following all day long.
Maybe you're on the right path there, man. Look at you're right about the breakout in oil here. At least it's been consistent with the drop in oil relative to planes, and the breakout in airline stocks, to the upside, working against that orange 20-day moving average. There's not been a big spike lower, right? A breakdown in oil prices that led to that spike. I think the spike there was led to actual travel numbers being higher than expected over the recent months. And then if you look, Mike, at let's just hit up our truckers real quick. We'll show the same thing. An excellent move. Now, this one stands out because of the level we're looking at. That green line, to me, calling out a very important ledge of former resistance, now potential support. Can you take a look at that 20-day moving average rising into that ledge? Looks really interesting to me, Mike.
Kevin, if you open that chart up, and I don't like to always throw out pattern names, but that's a nice little cup and handle. Like, you got a consolidation pattern down there.
Yeah.
You've got the cup, and you can see the little handle that it's making right now. Again, that's an optimistic look at that chart, but would be, painted from the bullish point of view, right? You're breaking above, that's a nice movement above the 200-day moving average down there right now with a downward sloping 200. Probably it maybe got a little ahead of itself right now. That's a pretty steep move. What was that move from that low? Yeah, right there. That's a pretty steep move right there.
That's pretty substantial.
So maybe we get some backing and filling. Maybe we just get some consolidation at what I would call this handle before we kind of maybe break out. But yeah, nice little pattern. Maybe I'll call it a bottoming pattern there, Kevin. That's what I would call that.
Potentially a bottoming pattern. And we say potential, Mike, because we're in the process of possibly testing that resistance band in green. If that stays held, and we call that red candle here a week ago, the test of that ledge and everything, and that's the low we see here, then this would likely be looked at as a bottoming pattern now, and new support evident at the green line ballpark here. 13,700 on this particular indice, as you all see me utilizing the Dow Jones index symbols here. I thought that was pretty interesting. And then let's look at the rails real quickly, and that's going to show you a similar move, although rail stocks not as much in this brand new uptrend. As you can see, rail stocks got through a band of resistance here that was notable on it's like a 2-year chart. Let me just pop that back. There it is. Yeah, so that maybe I should have put that line where it really belongs. Put that to actual resistance there, Horner. And there you go. You got to pull back to the 20 days. So we'll see if this carries as much bullishness as we've seen with trucks and with planes. But I often say, Mike, that it's important to understand the components that make up these various indices, particularly the transports in this case. And I wanted to make sure we revisited those 3 particular segments there. So, Mike, I think now might be an opportunity for us. We talked about oil briefly. Let's go ahead and talk about those precious metals that are coming into play today, because there's been a big move in a couple. We're going to actually lead with silver because the move in silver made a bit of a blow off top, it looks like. We'll see if this is a legitimate reversal or something less nefarious here. But what I want to remind you all as I bring up these symbols that are futures specifics. Just remember that futures and futures options trading, this is not appropriate or available for all traders. You always got to do your requisite work on our end of things, so make sure you're approved for it. It does involve substantial risk, and we are not recommending futures trading in any way. What we are going to do is talk about silver and gold, maybe a couple others from the trend standpoint. And Mike, it's this move today, this huge candle I'm going to zoom into. You could have been following along the trend line here for a while, probably using a 10-day moving average just fine. But that candle today looks like a bear engulfer, early in the morning here.
Listen, number one, it's, we're at 10 o'clock East Coast time right now. So 10 o'clock East Coast time, the market's been open a half hour. And I think your statement about commodities was, is very true. They do bring a little bit of risk, but since we're talking about there's always ETFs, Kevin, there are ETFs for almost all of these that are out there. But let's take a look. An engulfing bear candle. What does that mean? That red line, we opened higher than Friday's close, and now we're all the way lower current price as is at the low, below the low of where we were on Friday. So if the candle closes that way, that is air parentheses from a chart pattern. That's a little bit of a bearish signal right there, that we would engulf the entire move up, and then in one day we kind of swallow it right back down, right? So never makes anybody happy who follows charts. There's huge volume coming in with that makes it a little more tangible. You're like, hey, there's really some volume coming in on that, Kevin, that they're kind of selling this off. That being said,
FOMO,
right? So fear of moving out. Maybe you got gold up over over 100% this year. You got gold up. So people were kind of having a little bit of FOMO, and we'll talk about some of the other precious metals out there. But what I would say, listen, moves like this, we talked about it, when they kind of go straight up, and if you're looking from 42 to 85, and Kevin, how many trading days is that? Probably not even 15 trading days that we have on that chart. That is a little bit of a steep move. Yeah, start right there. How many days is that?
How about 25? So about 6 weeks
25
total,
trading days.
That's still crazy. It's 65%. I mean, or even more to the peak, 71%. I mean, these are not returns we typically see in the price of silver, the price of gold, right? These are a little bit extended, to say the least. We could see something similar, Mike, in gold here today. So gold's pulling back, but I guess, Mike, the question is, and of course, inevitably, we can't answer this question, right? We don't know if these pullbacks are just that, pullbacks to areas of potential support, or indications of potential weakness that lead to deeper pullbacks. Those are all on the table. It's our job as traders to manage our positions appropriately. And one of the levels you might watch on gold here is the breakout level. We're sitting below it right now. So maybe some traders are going to say the 20 days there, important exit strategy. Maybe traders, Mike, have already taken position off by virtue of today's pullback in gold, or maybe they've done the same in silver, right? Or they're waiting for the break of the 10-day in silver to make some of those decisions. Everybody's got a different approach, but the truth is we're very close to the highs. Yes, it's pulling back here today. The question, I guess, is anything different about the scenario associated with gold and silver that's giving traders reasons to believe that there's all of this upside in these two precious metals? I'm not sure that anything's changed since last Friday.
No, I don't think much has changed since last Friday. One of the anomalies that you can kind of see in the market, though, is typically gold and the S&P 500 don't always mirror each other. So usually, if the market has a strong year, we just used it. It was up at 18.5%, 17% on the S&P 500. Then you wouldn't expect that you would see gold up over 100%. Right? You wouldn't expect that. So that's not typical. Maybe we're seeing a little bit of a bigger picture. Maybe there really is a rotation, and maybe the economy, Kevin, is not as strong as we think it is when we're starting to see all of these commodities running at such a frantic pace. But that could just be me being a paranoid guy, right? That could be, but I do think the FOMO fear definitely has taken place in, a little bit, not as much as in gold, but more so in silver over the last few weeks.
Well, I think the story kind of led to that. There was not a story per se, but just maybe the collective reminder that silver has a commodity need relative to AI, right? It's part of an industrialized metal. It's not used like gold exclusively for precious and silverware, like jewelry and whatnot, which is more consistent with gold, right? Silver has many more uses, and I think that's one of the reasons you've seen kind of that, decoupling between the two, both in great uptrends, obviously, but nonetheless, something to keep in mind. Now, Mike, we should probably take a look around at a couple of these segments, these sectors in the market briefly. So we saw how oil's been kind of languishing. We've been below the 50-day moving average in oil for a while, but I can't help but think that if oil just got out of that downtrend, maybe energy would do something here. It is up 9.5% on a year-to-date basis, but really, Mike, the space. Oh, that's not energy. That's materials. Here's energy. It's really been lengthy, a lengthy drawdown here, or consolidation. Really, let's make this a 2-year chart once more, and you could see this pattern developing. You could look at this. I mean, it's just really gone nowhere for the year, up 5.75%.
And if you just look at that chart, as we've already talked about that pattern, now, this is an extended chart of lower highs, higher lows, right? So, and again, we're not talking oil itself. We're talking now the energy sector. So a big consolidation period. I would expect that, as we get towards that apex of the triangle, right, as you can kind of see that you're forming that triangle, we're pretty much there. So this pattern is going to break out in unfortunately, one direction or the other, and people tune into the show. Hey, Kevin, which way is it going to break? Kevin, tell me, is it going to be bullish or is it going to be bearish? But I do like right now that it's sitting above in this consolidated pattern. It is sitting above the 200. 200 is right where you're kind of, your apex is right now.
Yep.
Again, I don't know which way it's going to break. I have no idea which way the energy sector is going to break at all. But if you go with previous patterns, Kevin, move that out to like that. You have that full 2-year chart. Yeah, you're almost at the full 2-year chart on there. Typically when you get a pattern like this, it's what was the trend previously. And it seems like the trend is that period of lower highs, right? We're not making new highs right now. So unfortunately, that leans me to the negative side. But I don't really have a reason to be negative other than the way the chart pattern is kind of looking.
Yeah, maybe on the weekly, Mike, we look at it and say, really, we've been consolidating since 22, right? I mean, ignore the fact that we looked at it on the daily chart. If you looked at it on a weekly now, more or less going back to right about here, we could say that we've got a pretty lengthy consolidation that captures the majority of that price action, right? 580 up to about 750 or so. That's not a tight range per se, but it is a pretty clear range. And in truth, as you just said, one of those technical analysis tenets, Mike, is we had a huge push to the upside, and a huge push in a short time frame results commonly in a lengthy window of consolidation, digestion of price to validate whether it can be maintained. I feel like that's kind of what we're still in the midst of. This is not really evident on a daily chart, though.
I would say that was a good interpretation there, Kevin. Yeah, I kind of agree with that. Yeah, that makes sense. Like the market just can't go straight up. And look at that move that it made from 177 to to 562, almost the the upper sixes, and that was in a 2-year period. And we'll call it a crazy 2 years. I don't want to get into the COVID stuff, but it was COVID, right? It was the COVID time period, whatever you want to call it, right? So a little instability in the energy sector, certainly, right? We had oil go down to zero during COVID, right? Yeah. So huge rally up. What is the real price? Is it $100 a barrel? Is it $50 a barrel? And where do we kind of find that home? And I think we hit two extremes. We probably, we're getting closer to maybe finding a true price. And again, all the stuff that's going on with Venezuela right now, who knows how that's going to affect the markets as well.
Yeah, it's really hard to evaluate not just oil, but energy as well. When you think about all the narrative topics that can come into play, unfortunately. Let's look at some of those groups, Mike, that if we are broadening out this rally, the groups that may very well provide leadership in a broadened out rally, I would think that would be your big three, like staples. It would possibly incorporate also healthcare. And then we're going to look at the other two here. But, I think when I look at staples, I'm still encouraged by the fact that staples is not in a bullish trend here outside of the short-term 2 months. It tells me that traders aren't flocking away from tech and looking to buy up toilet paper and toothpaste.
Kevin, I agree with you, but if I just wanted to have some fun, short-term, right, you're making that period of lower highs. So we're not really necessarily selling those off either. They're right below the 200-day. It's a flattening line of the 200-day. It would take, me behind you, pushing your rear end to get above that 200-day moving average. That's not an easy task when it's so flat like that. It's not. So I am acknowledging that. So could we have some? Do we want to see the staples rallying? Well, if you're a bear, you want to see the staples rallying. If you're a bull on the market, you're not really. You want to see that run into resistance and kind of sell off after it runs into resistance. So depends upon your view of the market. We do look at the staples as the sector that people would run to if the market's running into trouble. We're not seeing it this minute. Things can change pretty quickly, but we're not seeing it this minute.
Yeah, and of course that's different for you and traders versus you investors. If you're an investor who's looking at a group that had a 2% year when the SPX has had a 20% year, you might be a 17% year, you might just be saying, maybe I need to devote some dollars to staples because I need to expose more money to a group of the market that's been lagging. An investor takes a very different approach. So please understand, very different conversations. If you're looking at an asset allocated portfolio over a 5, 10, 20-year window, you need to consider, regardless of what the chart says, that you have to deploy funds properly. And when I mean properly, it's to a model you're trying to match up against so that you can have returns that are expected and comfortable for you, and risk that you can manage on a portfolio quarter to quarter, year to year, et cetera. So just keep that in mind. Two different, very, very different approaches. We should touch on healthcare quickly as well. One of those other potential groups that might provide leadership in a market that sells off tech. Well, healthcare has actually been rallying back, but it's been kind of biotech, notably, I thought. That's been kind of providing some lift here. But Mike, the two big ones for me of late have been financials and industrials. So I wanted to touch on those with you, because both of them have been trying to break to new highs. And look at industrials here, basically holding on to the breakout level now. Got beaten back, came halfway down after that, after the first breakout, built a bull flag and followed the 20-day to the upside. Now we're back right above what was horizontal resistance for me, where I've got my crosshair.
Kevin, this is the kind of pattern, when things are just going straight up every day, it's kind of easy. Hey, jump on the trend, Kevin. They're going up, or unfortunately, if they're going down, jump on the trend, go down. Listen, sideways pattern for 6 months, right? Yeah. Lower level support, upper level resistance. As a chart guy, not this particular sector, the industrials, but as a chart pattern, yeah, those are fun patterns. Hey, can we see a breakout? We had huge volume late last week, probably you can see that huge green volume day. Had to be earlier last week, where we tried to break out above that trading range, right?
Yep.
And now, all right, again, the volume stinks, but this is a stinky couple of days from the market's perspective on volume. We're not going to get that. But yeah, that's a nice little breakout. Can we hold the north side of that line? Maybe, maybe not. That's about 100 points inside there. So if we could break out to the upside, we'd see maybe 100 points to the upside, and it would look like a nice breakout.
It could.
I can't say, hey, this is the best pattern in the world, but I like patterns that I can kind of define, where I see, hey, maybe the market is moving, creeping in that northward direction, upward, and maybe I can get a reasonable expectation from a measured move of where I think they may be going. That's all.
I like the sound of that too. And then if we look at financials, the difference here is that they've just been pushing. Instead of brief pullback into my range, it was a bull flag, broke into the upside, and now trying to hang on to the breakout of that bull flag, maybe build another bull flag up here.
Yeah, I think you might be correct on that, and I think we talked about the Treasury yield. Maybe the financials have a better sense of understanding of where yields are going, Fed fund moves, and maybe this is maybe like we said, not for 6 months. You priced in a half-point cut potentially over the next 12 months, but I said over the next 6 months, the market really wasn't expecting too much. So maybe the financials are kind of comfortable with this level at the 10-year Treasury, 4.1.
All right. Well, we're going to keep an eye on yields, obviously. Maybe that yield curve as well. That has some merit as it relates to financials. And I thought, as we round out the discussion today, I just wanted to touch quickly on the completion of NVIDIA's stock purchase there, or rather Intel's purchase of NVIDIA, I should say. And I wanted to look at those two real briefly. So that was apparently completed in a regulatory filing as of the 26th of December. So here's Intel, which has had a really great year, as you can see, 82% year to date. They picked up 5 billion stocks, They completed a stock sale to NVIDIA. I've messed that up in terrible fashion, Mike. I apologize. So they disclosed that sale, completing the issuance of 214 plus million shares of common stock to NVIDIA at a price of $23.28, an excellent premium paid for NVIDIA relative to current. So as you can see, Intel's done very well on that. And with regard to NVIDIA, as they pick up a big chunk, let's see here, because they've been under pressure for a little while, and they've just recently rallied back above that 20-day. I'm going to zoom in here. 35% year to date, not a terrible year by any stretch, maybe not what everyone's looking for from NVIDIA, but we are above the 20, above the 50. Looks like this 187 level appears to be pretty important for NVIDIA at the moment.
Yeah, listen, I think that NVIDIA, had a tremendous run up over the previous 2 years, almost 3 years, right? So
Yeah.
now you're seeing that little bit of a consolidation pattern. I'm calling it here at the top, at these higher levels for NVIDIA. So again, we talked about it. This is just maybe a consolidation pattern for NVIDIA. You got that support down there at that one, at this 165 level down there. You have that drawn in, and we're breaking out air parenthesis a little bit above that, that 187 level above the 50-day. Yeah, I don't know that. I don't know where NVIDIA is. Is it going to be $300 stock, Kevin, or is it going to be $100 stock next year? I have no idea. But I do think I like when stocks work off that overbought. And I think that's exactly what you're seeing with NVIDIA right now. The thing, has been the best stock out there for the last 2 years. All right, maybe this year wasn't the best year. That's all. It's just, working off that overbought.
Good way of thinking about it, Mike. As always, a really fun discussion with you. I love having you here once a month. Great to have you share some thoughts, some insights. And it's been a great year. So plan on having you back at least once a month going forward. And, of course, meeting up with you where we get the opportunity in those in-person events, man. Have a great rest of your year.
Right. Kevin, great seeing you. Wishing you and your family a happy new year, and all of our listeners out there. And I'll look forward to seeing you guys in 2026.
We will definitely be picking it up in 2026. You're not skipping 26, are you?
I said 2026. Did I go to 2027?
Okay. Never mind. It's still early. It's still early. But I want to thank all of you for being here. This will be my last class of the year. I appreciate all that you have done with me and for me, following me on X, supporting what we do on the YouTube channel. We greatly appreciate everything you do in following us. Thanks for being here. And don't forget to follow us on X, Ben Watson CS and Kevin Horner CS. Thank you, Ben, for being in the chat today. And I hope you all have a fantastic last week of the year. I look forward to catching up with you again in 2026.